Wonderful. Thanks again. Bye-bye. So there we go. The wonderful George Halmy at Click Events. Again, showing his extreme swing trading strategy. There we are. We're just at 11:18, a couple of minutes over schedule. I'm delighted to say Steve Ruffley, Chief Market Strategist at intertrader.com and also mentor at steveruffley.com, is waiting for us right now. So Steve is a favorite fan of the Fibonacci trading, and always gives us a great insight into what's happening in the markets. So let's bring Steve's microphone off and say good morning, Steve. You should be able to hear me.
Morning, Simon. How are we doing?
Oh, very well, very well. Good to hear your voice. Thank you for joining us on time. Always there, which is great. Thank you. What a very reliable participant speaker. We've been chatting on Skype this morning. I know you're coming down to London a week on Saturday for the live show, and you're going to be giving a couple of live talks there, which is great.
Yep.
But we thought you could just join us this morning to give us a little roundup and look at the main indices and the main forex pairs.
Absolutely, yeah.
So in your own inimitable style would be great. Shall we go over to your screen now?
Yep, let's do it, Simon. Yeah, let's crack on.
Fantastic. Things been busy with you on the? I know you're doing a sort of lot of mentoring now, also with Intertrader as well.
Yeah, as always. I mean, the markets, as everyone knows, are very volatile right now. A lot of unknowns. So where there's unknown, there's opportunities. So yeah, I've got a lot of interesting clients at the minute. You know, my kind of mentoring side, the kind of people I attract are from all walks of life. I've got NHS consultants, pilots, dentists, trust fund kids, all sorts of people. It's very interesting. I never have 2 days that are the same. So it's yeah, it's good times.
That's
But
the thing about
I can't
trading.
complain.
Yeah, trading is open to everybody. This is the beauty of it. It really is. Well, I'll
Definitely.
hand over to you. And obviously, people at home, if you just confirm that you can hear Steve and see his 8 charts that are live in front of us at the moment, that would be good with a little Y in the chat box. And also to these next 2 sessions, in fact, Steve and then Carol Harmer as well after Steve, quite interactive. So please let us know what it is that you're trading, what it is you'd like us to have a look at, and any particular questions. Please use the chat box to sort of get interactive these next 2 sessions. But Steve, I'll hand over to you. Thank you very much.
Cheers. Okay, good afternoon, guys. Quite interesting. I never watch any other presenters, and I must say this quite a few times, but I always catch the odd 4 or 5 minutes as there's a bit of a transition. So interesting, the last guy, I can't remember his name, but using MT4, and it just shows that all the kind of things that I had to pay a lot of money for when I was first trading, CQG, TT, Bloomberg, direct market access. My costs were upwards of £1,600–1,700 a month in the city before I'd even made a penny. And now, you can look at your screens and customize them exactly how you want, put all your indicators, save yourself all the bother of doing manual technical analysis, and, have these great views, and it costs nothing. It's all for free. It's amazing, isn't it, how technology has changed our lives in ways we never probably would have thought. So I'm going to kind of focus on Fibonacci today, and I call it my old friend Fibonacci. If I ever want to find out what value is, I go to Fibonacci. Now, if you read the book, The Rough Guide to Trading, there's 2 sections that are very much dedicated to Fibonacci. And this really comes back that anybody who started with me and read the book, got my software, and took the mentoring on, it's really clear that everybody has an affinity with Fibonacci. Now, the reason we have an affinity with it because we understand it. We're always trying to guess and predict what's happening to the right of the screen. Okay, so it doesn't matter, how fancy you make your charts look. All we're trying to figure out is from this point here, is the market going to go up or is it going to go down? What I like about Fibonacci is it takes the past. So we know what's happened in the past because it's there for us to see. And it gives you these levels to look at to then aim for the future. Very much, I guess, like things like Elliott wave. That there are certain kind of patterns, certain kind of movement that can help predict future movement. But the problem with the Elliott wave is a theory. So you don't know it's an Elliott wave until it's an Elliott wave. So it's a wave 1 to 5. And even then, you've got to see the correctional ABC phase. Whereas Fibonacci, you've got 2 distinct kind of ways of looking at it from my perspective. A strong directional move, which is just a trend, so going from a low to a high, yeah, and as long as you draw your Fibonacci from that low to the high, you get your pivots and points of attraction, or a strong overextended candle, yeah, which is just something that looks out of the ordinary. So when you look at the markets these days, there's plenty of them. So that's an extended candle, okay? Extended candle, something that just looks like there's been action, movement, interest in the markets. So once you look at these two ways of identifying Fibonacci, then you can then start to work within the principles. And this is where a lot of people fall down with Fibonacci, because it is so open to interpretation. A lot of people don't know where to start and end the Fibonacci. Well, I'll go through a few examples, and it's quite interesting. Again, the previous presenter touched on the New Zealand dollar and the euro. I will bring up my default charts in a minute of a correlation I've been looking at, and it's been pretty simple. I've been buying the pound low, selling the euro high, which has been tricky because the euro's got a bit of a bid, but generally, you have a better edge, in my opinion, of selling that euro high, and then just looking at places where the world's a little bit different. And New Zealand's a great example because 4.8 million people, the same landmass as the UK, 1.75 interest rates. A lot of kind of things that when you kind of try to put that into the UK's perspective are very different. So when you see something that's moved because of Brexit, because of, kind of external factors, then you can then quite easily look back to the fundamentals and the technicals and find some value. So as I say, I mean, what I'll do is, I said I'm going to focus on, obviously the kind of European markets, US markets, that kind of stuff. It doesn't really make any difference to me because, as I said, with technology, my fibs are always on my charts. We look at gold, for instance. This is just an hourly chart, but my fibs are here. And you can tell the fibs because, we all know what they are. The 50%, expansion points, retracement points here. So, I mean, gold, as you know, I've been fairly bearish. I still think it's got the option to get back to 1300, but we'll get it back to 1000 before we're ever getting close to 1900. So market gaps down here. Again, on the French elections, I'm not quite sure why France became, the world's global superpower overnight, but great, yeah, everyone can jump on the back of that. So that's fine, okay. So the market's obviously gapped down. So what I'm looking for is high points for the market to be overextended to get a decision point, as we have here in the 50. Yeah, the market's come down. Now, the old rule of Fibonacci for me is that, 80% of the time, a strong directional move will retrace to 50%. So you're always looking for that 50% as the first point of call. And then when that has proved to be a significant pivot point of interest, then your retracement points come in. So you can't really argue against this being a point of attraction on the hourly chart. So when we reject to move higher, what do? We go lower. So we hover around the 100%. So the next point of attraction, it's down here, 1260, down here, 1254, down here, 1244. So, yeah, I mean, it's as simple as that. And the whole point about understanding the markets, and, again, I'll touch on this massively when I do the live show in a couple of weeks, and it's truly about being right, okay, at the right time. Having the right opinion is fine and valid, but you have to be right at the right time. So, yes, you have to wait, a good amount of time for gold to come down here, and you're going to have to wait a good amount of time for it to hit these lower levels. So having an opinion in the markets, it helps you in one respect, but also can mean that you leave a lot of money on the table. If you look at this particular chart zoomed in on the 15 minutes, again, that hourly candle that pops out, here's your money here. You don't have to hold a trade, yeah, from the high to the low. It's not where the money is made in trading. The money is made is figuring out we've had a rejection, finally get a good solid point, buying size in areas like this, holding it for 5-10 minutes and getting out. Yeah, that's where you make your money. Areas like this, okay? Because only you should ever really be looking for 10, 15, 20 pips. Yeah, 25 pips maximum, I would say, in these volatile markets, and that's enough. But the whole point is how I make my money. I do that, but I do it with hundreds and thousands of pounds a point. Yeah, I don't mess around. I'm not interested in getting a pound a point here, holding on for 3 days and making 500 quid by getting out here. Not interested. I want to be making 10 grand here. I want to be making 10 grand here. That's how I make my money, and that's how I teach my traders to make money. Okay, so the people that are making 10, 20, 30, 40 grand a month under me are trading this way, because nobody tells you the real secrets of trading. They like to tell you that, you can compound your money, you can, hold a trading account for 6 months, 12 months, gradually build it up. It's all nonsense. actually, to be honest, in the retail sector. The majority of people that make money understand risk, and they understand that it takes money to make money. So that's why I have the tier, kind of sections to my mentoring. Starts with 5 grand, can't talk to me, not interested, you're not going to make any money. Yeah, up to 25 grand, we can have a chat, I can help you. Over 25 grand, generally around about the 100 grand mark, I can turn you into a 25 grand a month trader. And I've done it plenty of times. So that's the reality. And with the new regulations coming in from the FCA, it's going to be more and more difficult to trade a margin. Okay, so and use leverage. So the whole point is the world is going to get a lot more difficult before it gets easier for your average retail trader. So the idea of using Fibonacci is great, and holding things is great. But with holding things, you leave money on the table. Okay, so you're giving money away if you're selling gold as it goes back up. Yeah, and what you want to be doing is finding areas of interest around these key points, looking for breaks. Yeah. And just getting in and getting these small moves, making money, putting size through the market. Now, again, there's another way. When I go back to my trading days of old, back on the floors, the reason why people trade size and put volume through is that's how people get paid. So I was getting charged £1,600 a month in kind of fees for various kind of equipment, feeds, etc., etc., etc. And I'd make about £3,000 a month in spins, in rebates. So I would make probably £20,000-30,000 worth of spin costs. Margin, the kind of exchange would take their cut, the company I work for would take their cut, and I would get a rebate of the rest. So my spins, my actual trading interaction with the markets, putting volume through the markets, paid for my desk and also paid you some money. So you're in profit just by trading. And then the actual money you make, that's your profit. So again, these are things people don't tell you when you're a trader. So if you have a big account and you're trading £10 a point, watching your £10 go up and down, oh, I'm making £100, I'm losing £100, making £100, £200, losing £200, that's not where the money is. The money is people coming into the market here and buying 200 lots. As it comes back up, buying more, buying more, and then getting out here, turning and reversing, getting out here. And in that whole movement and transaction, if you do 2, 3, 4, 5, maybe £1,000 per point move and make some profit, yeah, you've already probably made yourself 200-300 quid in spins. So you do that a couple of times a day, understand that you're getting paid. So when I teach traders how to and mentor them, I'm telling them how to almost start a business. So when you come to me and mentoring, I don't tell you just how to kind of enhance your strategy and to be more profitable and use things like Fibonacci. I'm telling you how to make money out of the business of trading that everybody does. So when you come to me, you get trade back and you trade with me. I sort that out for you. So every time you trade, you get some money back. Yeah, and all of a sudden now the penny starts to drop and people are like, oh, I know why people do this, Steve. I understand why the markets move up and down like this, because every time it moves up and down, yeah, if people are putting size and volume through the market, win or lose, they're still making money. Yeah, that's right. Horrible, cynical, dirty world trading. What? What do you want me to do? This I'm just telling you the way things are. So again, Fibonacci wise, I'm thinking gold's got every opportunity to move back lower. So when you kind of cycle through all the kind of charts right now, broken the 50% short term on the S&P, looking pretty negative. What else have we got? The FTSE was a good one yesterday. I talked to a few of my guys about that. We came back down, beautiful, kind of, just breaking the levels. Support, this is where Fibonacci really works. When, kind of support resistance comes back, real technical style trade and breaks down, consolidating towards the low. So I'll be very surprised, with the kind of strength of the pound right now, if we don't just hold below 7246 and then you've got your natural target back to 7212. Now, FTSE's never particularly been happy above 7,000 and it's never been particularly happy above 7,300. So I'm pretty sure that the reality of the kind of Brexit negotiations and the more we hear about jobs going from London, yada yada, all the same nonsense we've heard, I'm still very skeptical about the way the FTSE keeps gapping and buying up. It's very difficult to see when there's 71p of every pound earning the FTSE being paid in dividends, how high the FTSE can go, and it's generally buoyed by Trump, America, following the kind of American markets. But as I've said, there's many people in Burn trying to sell the tops of the indices in general. So I'm not trying to kind of take any long-term views, that's for sure. But again, I'm happy at the higher levels in the fibs to sell into the upper levels, because I want to buy it low for sure. I'm still happy to dip buying the indices, but there still is value selling it as well. And again, the whole point is, we're not trying to be, right and have a swing trade and you kind of, sell here and buy back here. I'm not interested. All you want to see is these extended candles where you can make some money. That candle, 31 pips. So you need to make a quarter or kind of, a third of that move, and you've made your money. That's it. If you hold overnights, you're a position trader. If you don't hold overnights, you're just a scalper. Yeah, no matter how you look at it, you're scalping for a minute, an hour, 4 hours, you're still a scalper. Yeah, while the markets are open. So again, all these larger candles are just opportunities, yeah, to sell into. So have a view. Market's gone up, gapped a lot, 50%. We know that's a good pivot point. Yeah, so sell it, buy it, sell it, buy it, sell it, buy it, sell it, buy it. Yeah, I mean, how complex do we want to make trading? The levels are there. We know the Fibonacci works. We know it's on your charts. Okay, we know it's there for you. That's what we do by automation, by using, clever programmers as I have. They just put my views into green and red lines, and I just sit here, look for an opportunity, and get involved. So the pound, I'm more bullish. I've been telling you for months and months and months and months now. People laughed at me. People laughed at me when I said in 18 months, pound could be back at 164. Yeah, nobody's laughing now, are they? Because everybody that's been short the pound, expecting the world to end, well, the fibs are working the other way now. Support, support, support. Where do you want to get to? That 50%. Again, you can work the fibs however you want. Yeah, again, they're just showing you levels and points of attraction, where the market's been, yeah, and then where it can go. So, I mean, what I'll do is I'll show you some kind of things I've been looking at. So again, the pound versus New Zealand dollar. I've been talking about this for a long time. I've just become a brand ambassador for Pelicans for the first trade I put on, and I showed people was buying the lows in the pound. Now, again, I went through the kind of roughly the kind of fundamentals driving the New Zealand economy, and in essence, it's just what happened in the past can happen in the future. So if you look at the monthly charts, well, we sold off and it kind of consolidated, and then Brexit happened and we sold off even more. Fine. So what goes down will come up. So essentially, we're still trading off the back of Brexit. That's it. So people piled out of the pounds and put it into anything else. So as I said, 4.8 million people, same landmass as the UK. What productivity are they going to have going forward? Are they going to outstrip the UK's economy? Well, probably not. So what do? Well, we find out when the market hits a low point. So 80% of the time, a strong directional move, which this is, will retrace to 50%. So here's the high, here's the low. Until we make a new high, until we make a new low, we still have to assume that 80% of the time is going to happen. So where is the target? The 50%. So that puts us above 2, pound versus New Zealand dollar. Where's it going to? Well, it's going to the fib levels. It's broken above the smaller fib that I've drawn that I'll zoom into in a minute, but it's hit the 23.6, same in for the 38.2, and it's going to get to the 50%, probably. It's more likely now that it's going to try and test this fib here before it tests this fib and goes and makes a new low, isn't it? Because what's the new news going to drive that? There isn't a new Brexit. Yeah, it's not going to happen again. We've already triggered it. And yes, there'll be deals, there'll be uproar, there'll be wrangles with the EU, but it's getting priced in. So the priced in is saying that we haven't made a new low. So fundamentals, I don't know, it's too complicated to think about. But technically, 80% is quite a good bet that if we don't make a new low, yeah, we're probably going to test the 50% before a new decision point is made. So there we go. So as you zoom through the time frames, you start to see shorter term opportunities. Now, I'd never trade off the weeklies, but it doesn't mean the weeklies and monthlies don't have points of attraction. Of course they do, because they're set in stone. So I know the past. I'm trying to predict the future. I don't know what happens in this point here, but I'm using Fibonacci that's shown me what has happened on the way down. Now I know my rules. If they're right, if we don't make a new low or a new high, 80% of the time the markets will focus on getting back to a decision point, which is the 50%. So it could come in a week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks. I don't know. I don't care. I'm not interested. I just have a framework. So as I zoom through to the dailies, every time I see a big green candle, I think, yeah, I want to get involved in this. So what do? I do another Fibonacci. So Fibonacci of this big day here, that's out of the ordinary. Yeah, much bigger than the rest of these days. So what do? Look for that pivot point, the 50%. Yeah, so don't make a new low. Don't get back to the 50% actually. Find support on the 38.2. So what are my odds now that we're going to make a new high? Yeah, because this is an extended candle. So the extended candle rules is that, you put it on, no new high, no new low. It should carry on in the trend in which the market, the direction initially was, which is up. So if we don't get back and close below the 50%, you have 80% chance of making a new high. So what do? Hold on 38.2, once, twice, go up, come back down, don't make a new high. Decision point, call that a flag, pennant, whatever you want to call it. Again, consolidation to the upside, bang, we make a new high. So where does it get to? The 38.2. That's right, because that was a good Fibonacci level from the monthlies. Oh, right. Yeah, see how it starts to work? So where's it going to go to here? Well, there we go. All the way up to that 50%. And it looks a long way on the monthly and weeklies, but, when you've got days like this, that can happen. These big kind of, 550 pip candles. One, consolidation, two, consolidation, three, four, five. You can make any case that it could get there as quick as you like, or it could take months to get there. But it's having that framework. And again, I don't look at the dailies. I'm not interested in dailies. Go to our hourlies. Now we're talking. Now the money can be made. So again, what we're looking to do is figure out what's going to happen in the future. This point here. Yeah. So looks a little bit further away now, that ultimate Fibonacci level. But again, what we're trying to figure out is, consolidation, target, bounce, target. So what's more likely to happen now? Probably, if I want to buy the pound against the New Zealand dollar, I want to be kind of buying it down here. Yeah, the same kind of pattern, because as it's happened in the past, it's gone up. Yeah, big candle, supported. Big candle, supported. Big candles, supported. I mean, it's as simple as that. So, I mean, again, if you want to be looking and be a bit, kind of more aggressive, pick your next Fibonacci. Where's your next kind of support going to be? Well, is it going to be from here? Is this the next move? I mean, the trouble is, with the kind of open candles, we're always, at these points making new highs. And it's more difficult to put that finite, kind of point of interest in, because if you draw your Fibonacci from here to here, then it can't make a new high. Because if it makes a new high, you have to keep moving the Fibonacci until it comes back down, and then you're looking for that 50% as a bounce. So it's much more difficult to do the Fibonacci's from this perspective. But go back in the chart and just say, right, okay, well, the last kind of up move was here. So what you do is you draw it the other way and say, right, well, last big up move was here that we didn't kind of really retrace into. So where's that 50%? Okay, so the 50% acts definitely as an attraction point. Yeah, and we know we've made a new high because that's obvious. But what we do is look for the next attraction points for the fib on the expansion points. So in the short term, based upon this movement, which we know, where the market found support on the 50%, yeah, we know it made a new high, so that's fine. So the fib's still in play. It's done exactly what we thought. So the expansion points are here and here. Moving on to here. So these now, going forward, if the Fibonacci from here that we've drawn is going to still stay within the markets, which is like the recent bit of confirming upward movement. I know it's difficult, so we've got this as well, but just we have to try and find some kind of value somewhere. And if it's going to work, then you will see that these levels here that we've drawn in will all start to work the support resistance. And if it does, then that's just confirming what we found here. Now, not for everybody. Again, down to interpretation, down to your own individual knowledge and how comfortable you are with these things. But it's a logical way. We're in an uptrend, as we've seen. We've got some higher points, time frames, of interest that we want to get to. So now we have to wait it out and see. So again, if we get to this level here, it's going to probably, for me, as we've seen all this buying action, I wouldn't want to buy here. So what I want to see is a little bit of resistance, but I probably then want to buy here at 100%. And let it test that. So again, it's all about understanding, being right at the right time. Do you want to buy at what the end of the short-term push is? No, you want to sell. Then you want to buy low. So the whole point is, that makes it a little bit kind of, tricky, is that you have to kind of predict the future, and you don't want to buy high. You want to buy low. So if I want to buy, the pound against the New Zealand dollar, I don't want to do it here because we're making new highs, and I know it will go higher. But as soon as you do, you're probably going to feel some pain. So what you want to do is let the market extend, come down quickly, yeah, and buy at these levels, because that's where you're going to find your value. So that, again, that's one particular chart I've been looking at for a long time, and it's been very fruitful. I'm buying a lot of pounds against New Zealand dollar, and it's working out very well. So again, I don't hold longer term trades. So what I do is every time it gets to a low point, I'm loading up and then getting out, up the range. I'm going to buy some land in New Zealand, so I'm actually trading this for very different reasons. So I'm holding it for these specific reasons that I want the deliverable, which is, again, not my normal style. But in the interim, I'm still buying the short-term bursts. Now, conversely, we've got things like the euro pound. So if you ever listened to me on my 1,300-1,400 webinars, whatever I've done over the last 6 years, I sell the euro high. Why? Many, many reasons. You can tell me that the Eurozone economy is strong. You can tell me that productivity is up. You can tell me whatever you like. I'm not interested. I lived in Spain for 8 years. I know that it's all really for show. The European Central Bank and Mario Draghi is only interested in the central bank and Mario Draghi. They're not interested in the average person. So that will all come tumbling down at some point. So yeah, see the kind of gaps happening in the market being quite volatile. And the kind of the monthly view is that a lot could happen. But for me, again, Fibonacci's. They're already on the chart. They're already Fibonacci's I've used. Levels. Yeah. Where's the market going to get to? 61.8. It wants to get down to, 76. All these kind of levels are just parts of the equation. And again, you've got to pick something that, that ties in with your technical view, your fundamental view, and gives you confidence. The reason I've got confidence in Fibonacci is because I've used it for 15 years. So I can be quite blasé and I can draw them wherever I want and say, this is going to happen. That's going to happen. Now, you might think to yourself, well, I'm not quite as confident as you, Steve. Well, I know that's not the problem, but you have to get confident with them, because the more you use it, the more you use that 50%, the more it becomes an old friend. And it is an old friend. If I'm asked by Bloomberg, Reuters, anybody for a quote, first thing I'll do in a market, even if I've never traded it, I'll stick a Fibonacci on. I'll try and make sense of where it's been and where it can go. And that's all I'm ever doing. So as you cycle through the euro, for me, again, market is finding these points where these fibs are to be points of attraction. So a little bit of an interesting kind of weekly finish, noises out, the kind of EU about tapering, problems with Trump and his tax, etc., etc. But for me, essentially, this is still a great level, this 0.84302. So I'm looking for that market to close below it. And again, I'll just be carrying on, looking for that gap to be closed. And then, you just look in your hourlies. I mean, a great, island cluster formation could be potentially formed. And again, we need, a gap up here to make that island, remain. But the more likelihood is that the gap's going to get closed, and not because any other reason the market doesn't like gaps. My view of the euro is still quite negative. So we haven't got far to go, have we, really, to close that gap? I mean, it's looking vulnerable. We've got two very good points of attraction on the fibs, to let that gap then be closed. So, again, looking on the 15 minutes. Do you want to be selling it now? Well, you're selling it for a break. Yeah, but you might get a bounce here and it might come up. So be prepared. If you want to sell and break these bottoms, then, you've got a nice trade down to here and get out. And then let it, do what it needs to do. And then maybe it'll, slam back down again. I mean, look, some of the volumes that you see from the downside, you're not seeing them in the upside, are you? All the volume is from the selling side. All the volume. A little bit of buying relief here, but what does them three buying candles get with? They get, met with bang, a barrage of selling, and we're towards the low, towards the bottom. So again, it's just getting involved in the market, knowing you have framework, knowing you have points of interest, knowing you have sensible levels to get involved in based upon previous movement. So I mean, that's a great example of the pound New Zealand dollar, and again the euro pound. And it's again, these correlations haven't been working in FX and the commodities and gold and the indices so much. But in certain kind of scenarios, it still is working. When you see the euro get sold off against the pound gets stronger of something that's heavily oversold, the New Zealand dollar. So it's no coincidence that, we're making new lows euro pound and making new highs pound New Zealand dollar. And, you see a lot of people talking about the Australian dollar, New Zealand dollar right now because of that sell-off. Again, look, where are you going to find value? Well, of course you're going to find some value down here. The UK is not going to end. It's not going to crumble. It's not the end of the world because of Brexit. They wanted us to believe it was, but it isn't. So all this up here, just bags of value. Bags and bags and bags and bags of value. That's all we're doing. So finding on the short-term time frame how to get involved, and I'm trying to make some money out of that. So for me, you know, it starts to make a lot of sense the more you use previous movement to predict future movement. And, you know, you have to be quick sometimes. You know, a million times, you know, I've shown you when I've traded non-farm payrolls, that on the first 5-minute extended candle, we do a Fibonacci. And it's the extended candle rule that, you know, as long as we stay above or below the 50%, then a new high or low is going to be made, because that's the decision the market's made. On a longer time frame move, you know, a directional move, it's just a trend. So as long as the low or the high hasn't been broken, the 50% is the pivot. So two different ways of interpreting previous data from the short term and the long term for still your short term goals as a trader. So, I mean, has anybody got any thoughts, any questions? I mean, you know, there'll be lots of people out there that have tried Fibonacci and didn't get on board with it. A lot of people that, you know, again, would just say, you know, I still don't understand, Steve. You know, I still don't understand how you can use Fibonacci all the time. You know, and you have to break it down into these two distinct ways of looking at it. Longer time frame, strong directional move. Market goes from a point to a point and doesn't break that. So in the DAX, that is a strong directional move. Yeah, we've gone from a high to the low. Yeah, we found ultimate resistance, ultimate support. So the 50% is the pivot. So today, you're looking for that 50% to be touched. Yeah, and that's your goal. That's it. So if you only buy it now and make 35 pips out of it, Fibonacci will have done its job, because 80% of the time a strong directional move that doesn't make a new low or high will retrace to 50%. Then maybe that's done, and that's all you've got out of that one piece of Fibonacci. Or you look to sell that 50% if you don't get to it, or if you just touch it, yeah, and then let the down move continue. Those are your two options. Outside of that, it shouldn't really matter what the market does. But again, you've got some solid information based upon all this past movement, all these 8 hours of movement. So yeah, any kind of thoughts, questions, anything coming through, Simon?
Yes, Steve, thanks for that. Peter's asking, you may have covered this since he posted the question, but he just wants to see if you could reiterate how you define the bottom of a range.
Okay. I mean, let's do this. I'll find something I never trade. Blah, 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 blah. Europe, Norwegian krona, never trade it. So first thing we do, figure out what this market's trying to achieve. So it's always going to be difficult with things like this, because you know, the lesser kind of miners are never kind of traded. So what's the bottom of a range? What's the top of a range? Well, since this product's been charted, that's the ultimate top, that's the ultimate low. So are we interested in that? Potentially not, because that's a little bit too far back. That's probably, you know, well pre-Brexit. You know, lots of things have happened in the world. So what am I interested in? Something a bit more kind of future term. So I would say future term, this. The market has gone from the low to the high, made a double top. Yeah, always like double tops, especially when they've rejected. So this is a strong directional move up. Yeah, where's that 50%? Here. Yeah, so we've hit the 50%. So that's been proven. So we've got, from this perspective, we haven't made a new low, so the market can still go on to make new highs from this point. So here's your target point. Yeah, so we know that. So if we want to go a little bit closer to the action and what's happening, well, weeklies. So this is better. So this nice, you know, kind of hammer at the bottom of a downtrend indicates a reversal. Perfect. We like that. So low to the high. So what we're looking at now, market's gone from the low to the high. Where's the 50%? Here. Always, always, always a factor. Yeah. So what we have to think now is the market, this is a longer term view, the weeklies, scale through to the hourlies. So what's going to happen? Yeah. Gap up here, market's gone up. Yeah. So it's got every opportunity now to kind of come back down to 23.6 and still potentially bounce, because, you know, as we said, the trend, you know, is still pretty bullish, but then you don't want to be buying it here. You want to be buying it low. So if you want to buy it, you want to buy it back down here. So you've got the opportunity to sell it down to the lower fib level, or if you still want to carry on the buying momentum, wait till it gets down to these lower levels of value and buy it to go back up. That's it. That's how you identify these things. You know, you want to be buying low and selling high. Well, this is high. Yeah, so any buying you do is going to be dangerous. Even though the longer term trend is up, you want to be buying low. So this is a thing that, you know, a lot of people kind of forget about trading. If you're buying, you want to be buying when that is the biggest, reddest candle you've ever seen. Take your pain, because red candles turn green. You don't want to be buying into green candles. It's very dangerous. Likewise, you don't want to be selling, you know, into red candles, as I say. You want to be selling into green candles. So what you want to be, if you want to buy this, you want to see this red, 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 break, hold, and then then you buy. And as the candles start to go green, then you make your profit. Likewise, when if you want to sell it, you want to be selling when the candles are at the greenest. So here, so you have to take a bit of pain. But after green comes red. Does that make sense?
Yes, I mean, and just following on from that, Brian's asking, just to be clear, do you use the top and the bottom of the candle or the spike?
You have to use the spike because that's what the markets do. The markets inject volatility and fear around the extremes of the market, so they become the extremes of the market. Now, no, the whole point is the way the markets work and trade is that they're working on the assumption the average retail trader has a stop of 1 or 2% of their account. So how much kind of stick can the average retail trader take? You want to sell the S&P, which many people do. You see these spikes, yeah? They're designed to get people out, stock grabbers, pin bars, short squeezes. They're just the professional traders talking about how they manipulate the retail traders. So again, all these spikes up, you have to do your levels from these spikes because they're part of the chart, part of the information. So again, squeeze, 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 all the retail traders out. What does the market then do? Keep squeezing people up, but then the real action happens down here. So as I say, you want to be if you're selling it, you want to be after selling it at the highest point you can, taking as much pain as you can, knowing that what has been green will be red.
What about the volume of the spike? Brian's asking.
Well, the volume of the spike, is an unknown quantity. Again, you see a lot of these spikes happen around US data, where there's actual, quite low volume. So the markets can be moved, to hunt out stops, to move in the opposite direction, to get people out. I mean, the whole point of the markets right now is there's so much unknown that spikes happen just because they can. So if we're all expecting, Donald Trump to come out and say tax reform is going to be great for the US, well, yeah, of course it's going to be a spike to the upside. But then the reality is that it's probably better to sell into that actual news because the majority of people are just sheep. They keep following, the trend of the market. So where's the real money to be made? Yeah, get everybody long, get everybody greedy, yeah, and then squeeze the top and then smash it back down. So the volume of the spikes and these big candles are just a factor of the markets right now because nobody knows anything. There's no certainty about anything. So what goes up, 200-300 ticks will never stay 200-300 ticks these current market conditions because nothing's set in stone. So when you see again spike in the pound, yeah, going on to make kind of new highs above 129, what's the first thing he does? We'll sell into it because he's not rallying on any news, is he? He's not rallying on any certainty. He's just rallying. So the safest bet is to sell into that spike, but the overall trend is still up. So people are still finding value lower down, yeah, as the market settles. So it is particularly difficult to trade right now. I'm not going to make any bones about it, but the whole point about trading right now is if you're looking for swing trades and trying to find the extremes of the market, the big players are going to hunt you out, and you're going to be wrong more often than you're right. If you can identify a 200 pip move, we'll just trade it 3 or 4 times for 20 pips, and I guarantee you doing that every day, you're going to make more money and leave less money on the table than being a swing trader. It's just my advice.
What about, thanks Steve, sorry, I'm looking through the quite a lot of questions coming in.
No worries.
What about the fib levels? These are not proprietary levels, or am I mistaken? I think these are, fib levels are generally standard levels.
These are my fibs that I draw on the charts, okay? So these are my iView charts. These are charts that I use every day for my trading, for my funds, etc., 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 that are based upon my rules. If you want to draw your own fibs, then again, you just have to stick to the 2 rules: the strong directional move, no high or low made, 50% pivot, or the individual breakout candle, extended candle, 8% of the time it will go in the direction of which it was formed around that 50%. So that if you want to draw on themselves, that's why again I went back to that point. It's difficult for people to have the confidence in the fibs because they're almost looking for somebody to tell them, how do I draw my fib? How do I have the confidence in it? Well, I've just told you those 2 methods. If you do that day in, day out, on the products you trade, you will start to have confidence in these levels, and you'll trade, and they will work for you more often than they won't. It's about the most reliable way of charting I've found in the last 15 years.
Okay, and again, you've probably touched on already. Someone just asking, Amit is just asking about the fundamentals. You do look at fundamentals while also reading charts. They're
Have to,
not.
have to. It's 80-20. I mean, I would say that the 80-20 rule that I've talked about for years and years is probably different because the world is different. You've never seen a president move the markets like Donald Trump. You haven't. Not moving individual stocks and moving the markets. You just have never seen it. So the world has changed completely. Markets gapping and rallying on a French election. I mean, the French don't even care about the French. Nobody cares about France. But all of a sudden, any tiny bit of news is a
Yes.
little gem in this uncertain world. So you have to look at the fundamentals. And if you're a technical trader and think you can fade these markets, you come and see me in 6 months and tell me if you're still profitable. Not a chance. So yes. But again, even if you don't understand the fundamentals, still trade the moves from a technical perspective because it will marry up. You've got to just got to keep the faith, guys. Keep the faith. This is what I'm saying to you. The technicals will work eventually, and you have a higher probability of using things like Fibonacci over a long period of time. And don't look for these big, long moves, right? They're for the golf club traders who want to go down and pat themselves on the back and buy a round of drinks because they got 200 points on the FTSE for £2. Right? The FTSE can move 20 pips and I can make 10 grand, right? That's where the real money in trading is. And again, I'll come back to this whole point. I don't really ever sell stuff because it's not my style. And my mentoring is free. But that's why I have these tiers, yeah? Because I have helped people become extremely rich by having 25 grand in an account and incredibly rich by having 100 grand in an account, yeah? I'm not asking you to pay me anything, yeah? Open an account and trade properly with proper amounts of margin, proper amounts of leverage, and a properly sized account, and you will make money. Okay, I've got proper case studies of people making, as I said, 30 grand a month upwards off these amounts, 30%, returns, and they are few and far between. But I have much more success with people at that level than I do with people just coming in with a couple of grand. They're just another statistic, for the FCA to kind of point the finger at that anyone with 2 grand in their account, 95% of them never take that money out. It's 2 grand. It's in the markets, it's nothing. It's going to get swallowed and eaten up over a non-farm payroll. This is why all these things are skewed. And this is, 6-7 years of mentoring. And, the information, what's good about mentoring is that I can talk about these webinars and they're not always the same. I try and mix them up as much as I can, but I can't tell everybody what they want to hear or what they more specifically need to know. That comes on a one-to-one basis. And having that individuality and that talk and that ability to speak to someone on your level that's been through it, been through your emotions, that's where I get the most out of people. So the webinars are great, and that's why they're free, and that's why I keep doing them, because, they're good for people to kind of shake the brain a little bit and look at the markets in a slightly different way. The one-to-one time, people can get it in a minute, they can get it in 15 minutes, it can take a month. But that's the whole point. Everybody's different. And it's that little tiny little tweak that makes the difference between you being an all right trader and being a 20, 30 grand a month trader. There we go.
Okay, Steve Ruffley from steveruffley.com. Thank you. We'll have to draw it to an end there, but we're looking forward to seeing you in London for, of course, the RTC Live on the 6th of May. So anybody's listening, if you can get down to London for that event, you can meet Steve and attend. He's going to be doing 3 talks throughout the day, so we'll look forward to that. Steve, thanks again for joining us. Always good to have you on board. Thank you for that. I'm going to take back the microphone now.